ETFs are the most powerful way to build your wealth in the stock market, and it's also the most common way of investing for people in Germany. But how do you invest in ETFs? This is the guide that I wish I had when I was first getting started with investing. I've put a lot of useful stuff in this video, and I'll be sharing tips and strategies that most of you probably haven't come across. So let's jump right in. By the way, if you're new to the channel, my name is Essen, I'm a researcher, and on this channel we discuss how to succeed financially in Germany. What is an ETF? Let's begin with the basics. ETF stands for Exchange Traded Fund. An ETF is an investment that you can buy or sell on the stock market just like regular stocks. But here's the key difference. An ETF doesn't hold just one company. Instead, it holds many different things like stocks, bonds, or even gold. Think of it like a basket that holds many eggs, but instead of eggs, it holds lots of investments. So when you buy one ETF, you're actually buying pieces of many different companies or assets at once. If you buy one share of Google, you're only investing in Google. But if you buy one share of an ETF, you could be investing in hundreds or even thousands of companies at the same time. Let's look at the name ETF more closely. Exchange traded means you can buy and sell it on the stock market. It moves up and down in price just like any other stock. Fund means it's a pool of money that's invested in many things. It's not a single investment like a stock or bond, it's a group. There are different kinds of funds. ETFs, mutual funds, and index funds are all examples. They work in similar ways, but each has its own rules. Do you need a special account to buy ETFs? Yes, you do. And it's called a brokerage account or a Depotkonto in German. To buy or sell ETFs, you first need to open a brokerage account. This is where your investments live. It's like your bank account, but for stocks and ETFs. Personally, I use Scalable Capital for my own accounts, but there are many other good options. Some of the popular ones, apart from Scalable Capital, include Trade Republic, Smart Broker Plus, and Finanzen Zero. There are other popular options like Trading 212 and Interactive Brokers, but these are international brokerage accounts, and the biggest advantage of using German brokers is that they handle taxes for you automatically, and you only need to provide your tax information, and that's it. No need to worry about taxes with the German investing apps. Let's move to the next big question. Which ETFs should you invest in? There are over 12,000 ETFs listed globally. Just to compare, there are about 55,000 individual stocks in the world. So the number of ETFs is about 1/5 the number of stocks. That is a lot. So how do you choose the right one? Here's the key. You don't need to look at all 12,000. Instead, focus on a few that match your personal investing goals. Let me explain. What are your investing goals? Ask yourself, why are you investing? Are you saving for retirement and want long-term growth? Do you want to receive income from your investments? Are you getting closer to retirement and want something faster? Do you want to invest for 5 to 10 years and then use the money for something big? Your answer helps you know what kind of ETF is right for you. For example, if you want long-term growth, look for ETFs with stocks that grow fast and maybe even pay dividends. If you're close to retirement, look for ETFs that focus on bonds and more stable companies. Later in this guide, I'll give you a list of the best ETFs based on these goals. But first, let's talk about how to find ETFs. Here's where it gets fun. There's a free online tool I use all the time called Just ETFs. It's one of the best websites for finding and comparing ETFs. When you go to the site, you'll see a lot of data, but don't get overwhelmed. I'll share the most important things you need to look at. On the top, you can use the search bar to look for any specific topic or sector you are interested in. For example, gold. Here we have ETFs that invest in gold in some way or the other. You can select any of the ETFs and look at the specific details as well. But to make things easier, let's go back and have a look at the options on the left side. One of the most important ones is the savings plan. Here you can select which ETFs are available based on the investing app you choose. So let's pick the 4 apps: Scalable Capital, Trade Republic, Finance in Zero, and Smart Broker, and see which ETFs are available. If you've already selected a broker, you should select just the investment app that you are interested in. So in this example, let's just stick with Scalable Capital. So now we have about 2,600 ETFs left. Now when we search for a specific topic, only the ETFs available in Scalable Capital would be shown. For example, in artificial intelligence, we get 7 ETFs which are available on Scalable Capital. So you've opened the Just ETF website. You're scrolling through the list. Now what? Let's connect this tool to your personal situation, because the best ETF depends on you, your age, goals, and comfort with risk. Scenario 1. You're in your 20s, 30s, or 40s. You've got time on your side. This means you can be a bit more aggressive. You can handle a bit of risk in exchange for the chance to grow your money faster. Head to the Just ETFs website, then list by categories. Here you can select from dozens of options. Some options could be NASDAQ, which tracks big tech names in the NASDAQ 100. S&P 500 IT sector, which tracks the US information technology sector. The iShares Core DAX. The DAX index tracks the 40 largest and most traded German stocks listed on the Frankfurt stock market. These are built for people who want to grow their investments aggressively over time. Obviously, there are many other options which I'll discuss later in the video. Scenario 2. You're in your 50s and nearing retirement. Now's the time to play it safe. You probably don't want wild swings in your portfolio. You're less focused on aggressive growth and more focused on preserving what you've built. So you might want to look to add bonds or more diversified ETFs. For example, an all-world ETF in addition to an all-market bond ETF. Both are strong, stable options for someone in the later stages of building wealth. Please hit the like button if you're getting value from this video and consider subscribing. Let's say you find a few ETFs that seem interesting. Before you invest, you want to research them a bit more. That's where ETF fact sheets come in. These are pages that give you a detailed view of what's inside each ETF. Let's walk through how to find and read one. Perhaps you like the iShares Core S&P 500 ETF. You can go to Google and search for it directly. Click on one of the first results. That should take you to the ETF's official page, often hosted by Xtrackers, iShare, or any other providers. Let's break down what you will see. First, we have the summary. This is usually at the top. It tells you what the ETF holds, what index it tracks, and its recent performance. Let's look at the iShares Core S&P 500 as an example. It tracks S&P 500 index, which means it holds shares in 500 of the biggest US companies, exposure to a single country, and to large cap companies. So right away, you know this ETF gives you access to a wide slice of the US market, but it's not diversified in terms of location. Total expense ratio. This is very important. It's the fee you pay to own the ETF. Think of it like a yearly service charge. This ETF has an expense ratio of 0.07%, which means for every 1,000 euros you invest, you pay just 0.7 euros per year. That's extremely low. Always check this number. High fees eat away at your profits over time. If you find two ETFs that do the same thing but one charges more, go with the cheaper one as long as the quality is the same. Find the performance tab. Here you will see how the ETF performed over different time frames, the annual and cumulative results over the past 1, 3, 5, and 10 years, and since this ETF started. Don't focus too much on the one-year return. Markets go up and down quickly. What matters more is the long-term average. For example, if an ETF returns 15% last year, that's great, but it doesn't mean it'll do that every year. Instead, look at the 10-year average or the since inception return. That gives you a better idea of what to expect over time. The Core S&P 500, for example, has averaged around 11% annually in the past 10 years. Apart from the expense ratio, the domicile is also important because the fund's domicile determines which laws and tax rules apply for the fund, how dividends and capital gains are taxed, whether it's tax efficient for investors in a specific country, and which regulators oversee the fund's operations, like the SEC in the US or BaFin in Germany. You might see two ETFs that track the same index. One is domiciled in the US, like a US-based S&P 500, and the other one is domiciled in Ireland, like many UCITS ETFs. Even though they follow the same index, the Irish domiciled ETF is often better for EU investors due to more favorable tax treaties under the EU tax agreement regarding withholding taxes on dividends. But how do you know if the ETF provides dividends? Well, this is usually described in the details as well. For example, this S&P 500 ETF is accumulating, meaning that the dividends are not distributed and auto-invested. If you're looking for ETFs which give dividends, then look for DIST or distributing ETFs. Let's talk about a problem many people don't even know exists. It's called ETF overlap. This happens when two or more of your ETFs own the same stocks. Let's say you own both the iShares S&P 500 and the iShares S&P 500 Information Technology Sector ETF. You might think you're diversified, but in reality, all the stocks from the IT sector ETF are inside the core S&P 500 ETF. So instead of spreading out your risk, you're just repeating yourself. It can be a good and a bad thing. It can be bad because it defeats the purpose of diversification. If both ETFs own Apple and Apple crashes, both funds will drop. You don't reduce your risk, you just copied it. But on the flip side, if you want to add more weight to certain companies like the IT sector in this example, you can easily do so. Now that you know how ETFs work and how to research them, let's look at some of the most popular and useful ETFs based on your personal goals. You don't need dozens of ETFs to build wealth. In fact, most people can build a strong portfolio with just 2 to 4 good ones. Let's have a look at some of the most popular strategies. Number 1, the all-world strategy. I want a piece of everything. This strategy is perfect for people who don't want to choose between countries, sectors, or regions. Instead, they want to own a slice of the entire global stock market. The idea is simple. Buy one global ETF that includes companies from all over the world, large, medium, and small, across both developed and emerging markets. Example ETFs include Vanguard FTSE All World. This includes stocks from more than 40 countries. The iShares MSCI ACWI. This tracks both developed and emerging markets globally. People like this strategy because it's super easy. One ETF gives you exposure to thousands of companies worldwide. It's automatically adjusted over time as markets shift, and it's ideal for long-term, hands-off investing. This is a popular choice for someone who wants to set it and forget it. Number 2, the 70-30 split. Let's balance between growth and stability. This is a simple and smart way to split your investment across two parts of the global economy. 70% in the developed markets like US, Germany, Japan, UK, and 30% in emerging markets like China, India, Brazil, and South Africa. People select this strategy because developed markets are more stable but tend to grow more slowly. Emerging markets are riskier but can grow much faster. By mixing both, you're aiming to get a healthy balance of security and potential upside. Example ETFs include iShares Core MSCI World for the 70% in the developed markets and iShares Core MSCI Emerging Markets for the 30% in emerging markets. This strategy is for investors who want a little more control over the all-world strategy, as you can adjust the percentage if you want. Some people go with 80-20, others go with 60-40. It depends on your risk comfort. Number 3, all Europe or all US. Stick to what you know or where you live. Some investors choose to focus only on one region because they understand the market better and trust the economy more. They want to avoid currency or geopolitical risks. In all the US strategy, this means putting all your money into American companies only. US stocks have historically performed well and include giants like Apple, Amazon, Google, and Microsoft. Investors like this strategy because the US dominates global tech and innovation, and the US dollar is a strong global currency. Examples include the iShares Core S&P 500 ETF and the Xtrackers S&P 500 ETF. The All Europe strategy focuses on European stocks only. That might include Germany, France, the UK, the Netherlands, and more. Example ETFs include iShares MSCI Europe and Xtrackers Stocks Europe 600 ETFs. Some people like this path because they are EU residents and want to invest at home. They want to avoid US tax complexity or dollar exposure, or they believe in the strength and stability of the European market. Number 4, Sharia-compliant ETFs, investing in line with Islamic principles. Some investors follow specific religious guidelines in their financial choices. For Muslim investors, that means making sure investments comply with Islamic law, which prohibits investing in companies that deal with alcohol, gambling, weapons, pork, or interest-based banking, earning income through interest above a certain threshold and high levels of debt in the companies being invested in. Whether for religious reasons or ethical preference, many investors want to avoid industries or financial practices that conflict with their values. Sharia-compliant ETFs make that possible, while still providing diversification, growth potential, and global exposure. In German investing apps, there are only 3 Sharia-compliant ETFs: the MSCI USA, Emerging Markets, and the MSCI World ETFs. Now, ETF investing doesn't need to be complicated. The hardest part is getting started. After that, it's mostly about sticking to the plan. Start small, that's it. You can start with just €1, which I share in this video. And in this video, I share my own investment portfolio. So thanks for watching Black Vision, and I'll see you in one of these videos.